about a particular aspect of the housing market that is down 35% in 5 years. As we get started today, we are obviously out of town. We are doing this from a hotel room, but it is important to keep the daily financial news going because we all on this channel do the work, even when it is not easy and convenient. We will talk about this housing aspect. We'll talk about next week. We will talk about an amazing presentation that we gave at the Northwest Action Summit that is available and for you to consume. That and much more. Let's get into it. Shout out Lance Lambert at Resi Club for this particular aspect. But when you think about active inventory, right? Active inventory. These are homes that are listed on the MLS. Did you know that over the last 5 years, we are 35% below where we were 5 years ago, folks? Yes, according to Resi Club, the U.S. average inventory, active listings, is down, crashed, fell, collapsed, whatever word you want to use, 35%. That is a national number. Now, all cities are not equal. I have the top 3 and the bottom 3. You can check out Resi Club for all of the information. Austin, Texas. Austin, Texas, folks, if you're shopping in Austin, Texas, time to get aggressive. Austin, Texas, over the course of 5 years is up 26%. Yes, folks, 26%. Number 2, San Antonio, Texas, up 15%. And number 3, Memphis, up 9%. I think the craziest thing to look at when you look at the Resi Club chart is there are only four cities that have active inventory above where they were 5 years ago. Alrighty, folks, what about the bottom? The bottom, man, whew. If you're shopping in one of these cities, let me know in the comments below because, frankly, some of these numbers are frightening. We'll go right to the bottom. Down 79%. That's hard to fathom, right? 79%. Hartford, Connecticut. Number 2, down 72%. Providence. And number 3, this one surprised me, folks. If you're in this market, leave comments below because I want to know what's going on. Number 3 is actually Chicago. I would not have guessed Chicago. Chicago's got to be one of the largest MSAs in the country, probably in the top 5. Down 66%. Yes, folks, housing inventory for the country down 35%. That's a crash, in my opinion. When you look at some of the cities that are up, you have Austin at number 1 at 26%. So next up, I want to let you know that we were lucky enough, thanks to the folks at Northwest Action Summit, we actually streamed the One Rental at a Time portion, and we were really lucky, Dion and Mike also were able to stream their session. So if you want to get a little sneak peek to what Dion or Mike or I talked about, you just check us out on our channels. You can see the entire live stream. Appreciate the folks there and Dion for setting that all up. So again, if you want to see those, they are available on our channels. Again, we talked about how to find deals, how to use private money, all of those things. Let's talk about next week. Always interesting on Sunday to look ahead a little bit. Really, next week for me is all Fed talk, Fed talk, Fed talk. To me, it's really going to be who agrees and do we have any Michelle Bowmans that disagree with Jerome Powell? What do I mean by that? Michelle Bowman came out 2 weeks ago and said, you know what, we may have to go higher. Jerome Powell, obviously last week, said, not so much. But next week, we are going to learn, is Powell on an island by himself? Which is possible. He has been known to share his beliefs and not the group's beliefs in the presser when he is in front of the audience. And that starts off tomorrow. Monday, 2 Fed speeches. Tuesday, Fed speech and consumer credit. Wednesday, we have 3 Fed speeches. Thursday, of course, we have weekly unemployment claims, which are trending right around 210, 215. We will have a Fed speech. And then Friday, probably the most important economic number, we will get consumer sentiment. Folks, as I've shared many, many times, our economy is driven by the consumer. We saw that consumer confidence last week took a big hit. We're going to see what consumer sentiment does on Friday. And then finally, we round out the week with 3 Fed speeches. I want to go back and talk about something Jerome Powell did not say. I'm going through my notes here. I want to pull this out. So on Wednesday, Jerome Powell basically said we're not going higher. I think his exact words, we are unlikely to go higher. I did find it interesting. This is important. In the Fed presser, they removed the following sentence. I'm going to read it for you, and then I'm going to ask you a question. Here's the sentence that got removed. We believe that our policy rate is likely at its peak for this tightening cycle. Think about that. The Fed removed that sentence from their press release. If you take that sentence removal and you understand what the word unlikely means, maybe, I agree, I'm stretching, I'm reading between the lines, I'm probably crazy, but obviously I am searching for, is the Fed actually going to threaten to go higher? Again, I don't want them to go higher. I think going higher would be a mistake, but I do think they need to threaten to go higher. And maybe, just maybe, the removal again of this sentence, we believe that our policy rate is likely at its peak for this tightening cycle, is the signal to the Fed that we may need to go higher. I thought that was interesting. We got some active inventory. I think this one came from Altos Research. 2019, we had 1.137 active listings. 2022, this is crazy, 380,000 active listings. And then finally, 734,000 today. So again, we are up significantly from the bottom, but we are not yet close to previous levels. I want to talk about Grant Cardone. Grant Cardone said that the next 18 months will present the biggest real estate opportunities of our lifetime. And I kind of agree, and I agree. I think that over the next 18 months, we are going to start to see the real pain in commercial and multifamily. Everybody thinks office, but folks, you're not paying attention. You are not paying attention. The amount of stupidity, ignorance, just nonsense that occurred in multifamily is going to hurt a lot of people and provide a lot of amazing opportunities. As we talked about in the speech yesterday, that is live and on my channel, I believe that the next 18 months are going to be harder than the last 2 years. Here's an example for you. Shout out the person on Twitter under the handle Triple Net Investor. Triple Net Investor, you sent this to me, so thank you. There was an apartment building in Tampa, Florida. Florida, hot market, right? Nothing could go wrong in Florida. Oh yeah? Oh really? Here we go. In 2022, a building sold for $115 million. It just retraded 2 years later for $83 million. Folks, that is a $32 million loss. Again, short-term bridge debt, bad rent assumptions, taxes, insurance, these folks. Now, what really happened? Who lost $32 million? Not the bank. Folks, this is not the residential cycle. This is not 98% loan to value. $32 million, the equity. Said another way, LPs. I've been warning you for a better part of 2 years that a lot of LPs have lost their money and they don't know it. And again, a $32 million loss means the bank probably didn't lose any money. If they did, it was in the low single digits. So again, very interesting to watch. Let me go through my little notebook here because I don't have my normal setup. See if there's anything else I want to hit because it's been a couple of days. One sec, let me flip the page. Oh, jobs. We didn't talk about the jobs number. Jobs number came out on Friday and they were disappointing. if you were following the trend, they came in lower than expected, 175,000. The unemployment rate went up to 3.9%. Expectations were 238. Last was 303. So again, 303, 238, 175. Good. Is this the time where bad news is good news? What does that mean? The jobs number was so weak. What happened? Rates went down. Stock market went up. Why would that be? Well, folks want rate cuts. Folks, this is all about rate cuts. The job market is weakening, not as strong. They think that some layoffs will lead to rate cuts. I would tell you we got to watch inflation. Again, for most of my adult life, full employment was 6%. We're currently at 3.9. If you really want to get rate cuts because of a weakening job market, we're probably going to have to see a 5% unemployment rate, which is millions of folks. So I would argue, be careful what you wish for. So again, folks, a lot of stuff going on, lots of Fed speech. Hopefully you enjoy the live. Shout out the team at Northwest Action Summit for giving us the opportunity to stream that. Thanks, Dion, for helping us set that up. You are a wonderful team member. And again, go over to Dion Talk and see him and Mike, Millennial Mike, give an amazing talk as well. All right, folks, take care of yourself. Looks like we got through this in a hotel room. You're amazing. Like, subscribe, comment. Have a great day.